I am very pleased to have Veronika Kapustina as our guest today. As I've told you repeatedly during class, she is one of the partners at Houghton Street Ventures, which is a key contact for you guys to have and to use, hopefully going forward in your lives as entrepreneurs, investors, etc. So without further ado, thank you for being here.
Thank you. Thank you for having me.
So I thought we would start with just thinking a little bit about your journey to here. So I know that you spent a lot of time in Morgan Stanley right after school. So can you tell us a little bit about that? Why was it useful? What did you learn, etc.?
Sure. So I took a very classic LSE path. I did economics at an undergrad level. And then when I graduated, I went to work at Morgan Stanley and was just very fortunate with my timing. I went there in 2011, and the first 2 years I worked on the two biggest internet deals since Google went public. And so that really set me up in terms of kind of falling in love with tech, just falling down that tech rabbit hole. But at the time, there wasn't that many deals happening in the UK. So I wrangled a move to the US. As soon as I could basically ask them to transfer me, US visas are always an issue. They put in a transfer, and I moved over to Menlo Park, which is about 45 minutes south of San Francisco, and went to where it all began on Sand Hill Road. I landed on a Saturday. On a Friday, I was in Uber's boardroom. That was my first client. My next client was Netflix. I'd spent a couple of years in London before moving in leverage finance, so working on the debt side of things. And kind of that's why they staffed me on the Netflix deal. Netflix at the time was raising $1 billion to $2.5 billion of debt every year, just to fund content acquisition. And then my third company that I was staffed on was Airbnb. And at the time, Airbnb was just worth $10 billion. And they wanted to raise $1.5 billion. We did that with them in about 3 months. They had 3 people working on their side. We had a core team of 4, plus kind of a lot of senior bankers advising. And it was just an incredible opportunity to be in a room with people who, this is 2014, kind of 2015. Airbnb was started 3-4 years before. So seeing that incredible growth, seeing the people behind the growth and being able to interact with them was really, really inspiring. And contributing very much on kind of the modeling, kind of the support of the founders, helping them pitch to investors, stepping in when investors' calls overlapped. It was a great experience, and just being in the room, I think, was what really made it exciting. I think the other thing which was fantastic with Morgan Stanley is it's a global firm, so I got that move to San Francisco, and that's what really precipitated everything else, because once I landed there, people started referring younger founders to me and saying, hey, it looks like you might be able to talk to them about some interesting things. And once you spend a weekend or two on someone's business model, figuring out their hiring plans, figuring out their, what their strategy is going to be, at 28, I was the gray hair in the room with some of these founders. You really want to participate in their upsides, so I basically started angel investing. That's how it started whilst I was still at Morgan Stanley.
Oh, that's wonderful. Yeah. So you got both the experience that you needed in terms of knowledge, what exactly are the questions you should be asking, how to think about the structure of a deal, but also the connections that potentially build up, your pathway towards building your own fund.
I think the opportunity is really, being exposed to, that kind of people, the entrepreneurialism, the belief that everyone can build something. That's what really, I think, drove everything else. And, and the serendipity of it. So the first company that I invested in ended up going into Y Combinator. So as an investor in that company, I was invited to the demo days. And so I started taking sick days at Morgan Stanley to go to demo days at Y Combinator. And very quickly just fell in love with the early side of the work and realized that what I was learning day to day at work in terms of, what kind of all the senior bankers were advising some of these companies could really well be applied. Not perfectly, of course, there's some adjustments when a company is tiny, but in some ways it could be applied back down to at seed stage, at early stage. And, so much of the early stage investing decision is about the founders. So being able to see some of these exceptional people up close and then transferring pattern recognition to younger founders, that was the opportunity.
That's wonderful. So tell me what happens next. So I know that you went to Next Gen Capital, still in the Bay Area. So tell me a little bit about that. And what are they? Let's start with that.
Sounds good. So I left Morgan Stanley in 2017. I'd learned a lot. I'd spent time on the equity, on the debt side, worked in kind of proper investment banking coverage. So really had, I felt like I'd seen every side of deal structuring and felt I was ready for the next challenge. So I left and focused full-time on angel investing. A friend of mine who I'd known for over 10 years approached me and said, hey, why don't we start a fund kind of between London and California? We'll set up the fund in London, but then you'll strike up a few partnerships in California and kind of we'll go from there. I thought, this is fantastic. Like, I have a co-founder, like they're older, they have experience, like they'll bring the capital. This will work really well. So for me, it was an incredible opportunity to learn about fund formation, how to set up the legal side of the fund, do all of those really kind of boring but necessary things in terms of getting something off the ground, and also leverage my network in San Francisco. So I helped him strike a partnership with Berkeley, a soft one, not a hard commitment, but still, and leveraged a lot of the people that I kind of built up relationships with over the previous 3 years. What was interesting for me was that I always thought that co-founder issues existed in companies, but actually co-founder issues exist in any business. And very quickly, about 6 months in, I realized that whilst it was an amazing opportunity to learn, I really didn't see myself here for longer than a year, because long-term, the way that we looked at strategy and opportunity was really different. So about a year after I started, I decided to leave. And there was a two-pronged decision. One was the co-founder side of it, and the other was that I decided to move back to London and kind of see what was happening in the tech ecosystem back here. And that's what prompted the move back. Yeah.
So let me go back to the point you were saying before about angel investing and how you started really early whilst you were still working at Morgan Stanley. So tell me a little bit about that journey in terms of both how did you get access to the companies, like deal sourcing, but also how do you think about compensation for your time, negotiating with the founders in terms of, are you going to get equity, how much of it? And just to give you some context, remember guys that when we spoke to Joel about his company and about advising, he said, look, mentorship was crucial for us, but you have to be stingy about equity, right? Remember, he was very stingy about the equity part. And he said, overall, to all our mentors, we did not give more than 1% of equity overall. So I want to turn this question now to an angel. How do you think about equity compensation and that negotiation with the founders?
I think there are many different kinds of angels, and in my case, it was really about access to capital, early kind of advice on company structuring, team structuring. That was what I brought. Like decisions around how to, where to incorporate those kind of things. I was actually terrible at negotiating my compensation. So I was very good at getting the angel checks in and getting access. But, in terms of that kind of 1% comp that Joe was talking about, I have a lot of friends in the Bay Area who went down that route, but many of them had company building expertise, and I'd never actually operated a company. So it was hard for me. I didn't really have a foot to stand on in terms of coming in and saying, I know how to do this. I had an idea, and I could give them a general direction, and I was really great as an advisor, but I wasn't fantastic in kind of being in the trenches with them. So knowing that, what I opted for was basically putting in a small check and then helping them with a network, really helping them with something that they didn't have time to do themselves, which is build a network of other investors, other advisors, and then making those referrals. And, many people in the ecosystem would say that, yes, you should get compensated for that too. The Valley is a little bit different from London. Like, yes, people get compensated for committed time. So if you're really helping somebody build out their revenue or business opportunities, 0.5% to 1% is pretty normal for compensation. But then you're tied into results. Like, this isn't just, maybe I'll help out like when I have the time. But in general, when it comes to introductions, when it comes to putting people in front of other people, it's part and parcel. It's part of the currency of how people operate out there. So people are usually very generous, and it's not very common to ask for compensation for an intro, or even if someone ends up investing in that company. So it's more, it's a favor economy, if you like. I pay a favor to you, like I introduce you to a great company, I get a founder some money. This means that down the line, I'll have a better sourcing engine because, at that stage, there's no data that tracks how many companies get started, where they get started. It really is about hearing everything through the grapevine. And so what does that mean? Angel investors, everyone approaches it differently. Some people have a core group of people that they spend a lot of time with and they source together. Other people are very social, so they go to a lot of conferences, they go to a lot of events, they get close to certain funds, and so when a fund sees something that's too early for them, they'll refer it to the angel investor. Yeah, so that was the approach, really. I mean, for me, it was a little mix of both. I built deep relationships with some other angels, and then, I really enjoyed kind of the conference gig for a little while. Then I got very tired of it, and yeah, it was. It takes the time to figure out what kind of angel investor you're going to be, but you have to play to your strengths, and you also have to be, I think, very honest with the founders. So I did have an example of one company that I invested in, and they really needed somebody to help them on the revenue side of things. And there was somebody who I thought was really well qualified for this, so at least from her CV. So I introduced the founder to this individual, and this individual secured their 1% compensation, but then proceeded to not deliver on anything for the next 6 months. So again, if you're a founder and you're giving out comp to angels, put a cliff in there. So maybe a 6-month cliff or a 1-year cliff, so that you can actually see that there's some proof of them being able to help you out, rather than just distributing your cap table on the basis of someone's reputation.
That's a great advice. Thanks for that. So anyway, so you had all this experience in Morgan Stanley that took you to the Valley. You started doing some angel investing. You also went through the whole process of creating a fund. You decided you didn't want to stay too long there, and then you came back. And what happened?
Well, I was really moving back on a whim, if I'm super honest, so if I can be really open. So I decided to move back for completely personal reasons. I didn't have a job lined up. I was thinking about, continuing to angel invest here. And again, this is the importance of spending time with your peers and really letting everyone know what your plans are. A friend in California, a venture investor, said, if I was moving back to the UK, there's one place I'd want to work right now. They're building something really exciting. And so he connected me to Oxford Science Innovation, or Oxford Science Enterprises, which is a fund that's affiliated with the Oxford University. And at the time, I was actually considering whether to live in London or actually be a little bit further north in Oxford. So, I took a meeting with them. One of the portfolio companies needed some help, and very quickly we came to an agreement that I would help out for 6 months, be an advisor to the CEO. For me, this was perfect. I was doing that 3-4 days a week. I got introduced back to the London ecosystem. I met all the VCs because the company was fundraising at the time, so we did the VC rounds. I understood how that model worked, how the Oxford model worked. I thought it was brilliant, because the one thing I never liked about venture was this unpredictability of sourcing. As an angel, it's a lot easier. It's like you just follow your interest, right? With venture, it's like, okay, so I'm a fintech investor in the US. What does that actually mean? Right now, fintech investing is anything from social commerce platforms to pure fintech, B2B SaaS software. It's an enormous remit. So I just thought, if I ever want to do venture, I don't particularly want to stay up nights thinking what I've missed. It would be nice to actually focus on one ecosystem, and I thought Oxford had cracked it. I knew this model existed in the US as well. I'd seen it at Stanford with StartX, Harvard, X-Fund. But it was the first time I saw it in operation in the UK. The very particular thing about the Oxford Fund was that they were focused on IP. So they basically struck an agreement with Oxford University to have first dibs on all IP coming out of Oxford for the next 15 years, which seemed like a crazy deal, But they negotiated well, raised a lot of money for it, and started that fund in 2014, 2015. And when I got back in 2018, 19, it was well on its way. My one question on every commute to Oxford was, why on earth was I on this train when there's a bunch of very smart people 20 minutes away from my house on LSE's campus? And I'd already angel invested in some of them, and I'd never heard of anything like the Oxford Fund being set up at LSE. So I was really excited to work with the Oxford team. They're brilliant. But I couldn't let go of this one question, which eventually I asked, and that's what led to Houghton Street Ventures.
So let me try to push back a little bit, because the entire Oxford system, as you described it, is based on this IP that is being developed in a house, and then potentially there's some investment value there while you commercialize it. Whereas the LSE doesn't have traditionally this big IP community. We're a school that is based on social sciences, humanities. Oh, I don't have a mic. So LSE is a school that is not based on IP or hard science. It's more of a social sciences school. Humanities very strong. So what was the thesis there? So that it's not exactly the Oxford model, or what do you have in mind when you think about the LSE?
Sure. I mean, there's different ways and different things that you can commercialize. And in the US, what you have is they're very good at affiliate monetization, so affiliate networks. That very strong affiliation that you see that US alumni have with their university, the sports team, the jerseys, etc. Like it translates very well to venture, right? So there's a fund in the US called the Alumni Ventures Group, which set up about, I want to say at this point, 17 or 18 partnerships, sometimes formal ones, sometimes loose ones, with universities across the US. They raise from alumni, they invest in alumni. I think they're the largest venture investor in the United States in terms of number of portfolio companies, because their checks are small. They're like $100,000 to $150,000. And it's easy to let them into the cap table, so they're co-investors for a ton of deals. It's probably the biggest index investor across venture if you want to think about it that way. So I think the thing in common is the sourcing approach. So it's, the Oxford Fund is fully focused just on Oxford alumni. But then the actual, the meat of it is slightly different. Yes, we don't have IP, but we do have a very strong brand. And believe it or not, LSE also has very strong affiliation kind of sentiments, basically. People just haven't had a chance to express them, I would say. So unlike US universities, we don't have so many alumni events. We don't have so many opportunities to really re-engage with the university. So in the early days when we were looking at, would this succeed, there's a few questions we had. One was, is the LSE ecosystem big enough? And is the connection with the school strong enough? And those two got answered pretty quickly. We did an initial scrape, and we found that LSE has over 20,000 alumni founders out of an alumni base of 200,000. That's in line with the Ivies in the US. So 10% is commensurate with Harvard, with MIT, with other big unis out there. So like, okay, the size, check. That kind of works. And I'll go into the data a little bit more later. On the kind of affiliation piece, we spoke to a few unicorn founders a couple I knew from California, a few more were here, and found that yes, like for them, like if they knew that this had existed when they were building their business, there was a lot of feedback saying they would have loved to either let us into the round or get us support or in some way get us involved. That was enough of a hunch to then kind of to continue building. So differently from Oxford, we're not commercializing or monetizing IP, but we are commercializing and monetizing the affiliation piece, so the affiliate network around LSE. And frankly, you can do this with any affiliate network. And in the US, you do this around high schools. You do, a lot of high schools raise very successful endowments as a result of this. You can raise money, you can invest, around many, many different affiliate networks. It doesn't have to be around the university. So that's what we went with.
Wonderful. So last question from my side. So Houghton Street Ventures. It's not only you, right? You've got two other great
It is
team members. No, wait.
Yeah.
So I just wanted to ask you, how did you meet them? How did you find them?
That's a great question. I was really lucky. When I asked the question, like why LSE doesn't have a fund like this, I started getting to know more about what LSE did have, and LSE had LSE Generate, which is the Center for Student Entrepreneurship at the school. So I got connected to them and started sitting in on their judging competitions, kind of the, a few of the mentors, the accelerator they ran, and so through that I met Hannah. Who's sitting on the right just there. And Hannah and I, were judging, we're both judges on this one panel, and we completely disagreed on a company evaluation. We looked at, and we're like, okay, so had totally different views on whether this company would succeed, whether anybody would actually use the business, the product they were creating. And we realized that we had a very different way of thinking, and we could really see each other's blind spots. So that was a great sign. And the more we talked about this idea that there should really be a platform that exists for LSE alumni founders, the more excited we got and decided, yeah, we wanted to work on this together. Hannah then introduced me to Adam. So Adam's journey, and I'll give you the backgrounds on both of them, actually. So Hannah's journey was, actually, let me start with, let me go through the introduction first, and then I'll go back to their backgrounds. Hannah introduced me to Adam, who was building his own company at the time, Scalable Capital. It's now a unicorn. And Adam was actually, he's a builder. He loves to create things, to get his hands dirty. Scalable was at that point at the scale where truly, it didn't really need builders anymore, it needed managers. And he didn't want to become a manager. He wanted to get back to building. So we caught him at a perfect time when he was thinking about his next steps, and we told him about this idea. And Adam, being a statistician by training, so he did maths and stats at LSE, said, great, okay, let's look at the numbers. And so that 20,000 number came out that I told you about a little bit before. But then when we did more and more work, well, when I say we, the royal we, Adam, when he did a lot more scrapes on the weekend, we figured out that LSE alumni founders were raising steady state something like $5 to $6 billion a year. And that's like 500 million of that just in seed. So the opportunity was there. A lot more work later, we found out that in 2021, which was a blockbuster year for venture, LSE alumni founders raised $11 billion in funding. $11 billion, just to give you a sense of scale, is the same as the entire ecosystem of France. So all French founders, in 2021 raised $11 billion, and that's the same as LSE. If there can be funds that can support the French ecosystem, there should be a fund that can support the LSE ecosystem without people challenging us on adverse selection and saying that this pool is too small. So that's how we came together and how we got excited about the opportunity. In terms of Hannah's background, so she did a master's at LSE and was very focused on going into development. And basically, in her own words, got waylaid by fintech. And this is back in 2012 when fintech wasn't really a word, but she was really she worked with a very eccentric American entrepreneur and then went to work for Anthony Jenkins and built the first Smart Cities Accelerator at Level 39, Canary Wharf Group. She then went to work at Ernst & Young to set up their fintech practice, so super early days, and through that she met Adam, who at the time was a seed stage entrepreneur, and going to every single networking event he was invited to. Now you can't get him out of the house. So Adam's journey, so maths and stats undergrad, then he went to Goldman. He was a trader, commodities trader, but fortunately for us, he wasn't just a trader, he was also responsible for building out the retail arm of Goldman's commodities trading division. And he met 3 of his co-founders there, 2 or 3, I forget, but a substantial number. And they all decided to leave to start Scalable Capital, which is a wealth manager here in Germany, now backed by Tencent and BlackRock. So then he spent 7 years scaling Scalable and decided to restart. And towards the end of that journey, he started angel investing. He started advising early stage founders. He also doesn't take any equity for his advice. It's very much a pay it forward model. He remembers how much people helped him when he was starting out, and so he wanted to do the same, and realized how much he loved it, and eventually more than his day job. So that's what brought him over to us.
That's wonderful. Thank you for sharing. So now it's your show.